Let's dive into the world of interest rates, a realm that quietly influences nearly every aspect of our daily lives, often without us even realizing it. While we go about our routines, shopping, working, saving, or borrowing, there's an invisible hand at play, subtly guiding the flow of money and the choices we make. This invisible force is the true architect behind your financial well-being. Whether you're planning a family vacation, buying a new car, or simply trying to make ends meet, interest rates are working in the background, shaping the outcome of your decisions. They determine how much you pay on loans, how much you earn on your savings, and even how much your monthly bills might fluctuate. Think of interest rates as the price tag attached to borrowing money. When you take out a mortgage to buy a home, or swipe your credit card for a purchase, the interest rate decides how much extra you'll pay over time. It's not just about debt though, interest rates also influence how quickly your savings can grow, making them a crucial factor in your long-term financial planning. At the heart of this system are central banks, like the Federal Reserve in the United States and the European Central Bank in Europe. These institutions act as the DJs of the global economy, adjusting the tempo by raising or lowering interest rates. Their decisions ripple outwards, affecting not just banks and businesses, but every household and individual. When central banks decide to raise rates, borrowing money becomes more expensive. This means higher monthly payments on mortgages, car loans, and credit cards. As a result, people and businesses tend to spend less, which can slow down economic growth and help keep inflation in check. On the flip side, when rates are lowered, borrowing becomes cheaper, encouraging spending and investment, and giving the economy a boost. This single number, the interest rate, has a direct impact on your mortgage rate, the interest you pay on your credit cards, and even the returns you see in your savings account. It's a powerful lever that can either help your money grow or make it harder to get ahead, depending on which way it moves. In many ways, interest rates are like the gravity of the financial world. You can't see them, but you definitely feel their pull. They keep the economy balanced, ensuring that money flows where it's needed most, but they can also make life feel heavier or lighter depending on their direction. So the next time you hear news about interest rate changes, remember, it's not just a headline. It's a signal that your financial landscape is about to shift. Whether you're a saver, a spender, or somewhere in between, understanding interest rates can help you make smarter decisions and stay one step ahead in the ever-changing world of money. Central banks, those powerful institutions that often seem distant from our daily lives, are suddenly paying close attention to your wallet. Why? Because inflation, the silent force that makes your money buy less each year, has become a major threat to economies worldwide. When prices rise too quickly, your paycheck doesn't stretch as far, and everyday essentials like groceries, gas, and rent become harder to afford. To fight this, central banks raise interest rates, making it more expensive to borrow money. This move is designed to slow down spending and borrowing, which in turn helps to cool off inflation, the villain quietly eroding your purchasing power. By increasing rates, central banks hope to encourage people and businesses to think twice before making big purchases or taking on new debt. The goal is to reduce demand just enough so that prices stop rising so quickly, but not so much that it causes a recession. It's a delicate balancing act. Too much tightening and the economy could stall, too little, and inflation could spiral out of control. For everyday people, this means higher loan and mortgage rates, but also the hope that price hikes at the store will finally slow down. In the United States, the Federal Reserve's rate hikes are aimed at cooling off a red-hot job market and strong consumer spending. Americans have kept shopping and businesses keep hiring, even as borrowing costs rise. The Fed's challenge is to slow things just enough to tame inflation, without putting millions out of work or causing a painful downturn. Meanwhile, Europe faces a more complicated puzzle. The continent is made up of many different economies, each with its own strengths and weaknesses. Some countries are booming, while others are struggling with high unemployment or slow growth. The European Central Bank, or ECB, must find policies that work for everyone, even when their needs are very different. When the ECB raises rates, it's a careful operation. While it's necessary to fight inflation, higher rates can hit weaker economies especially hard, making it tougher for small businesses and families already facing challenges. The risk is that some countries could slip into recession even as others remain strong. In Europe, inflation is often driven by factors beyond the ECB's control, like surging energy prices or global supply chain disruptions. This makes the job of controlling inflation even more complex, as raising rates can't fix every problem. especially those coming from outside Europe's borders. Ultimately, central banks are trying to walk a tightrope, balancing the need for economic stability with the risk of triggering financial distress for families and businesses. Their decisions affect everything from your mortgage rate to the price of bread, making their actions more relevant to your daily life than ever before. It's a high-stakes game with consequences that ripple across the globe. As central banks act, the world watches, because what happens to your wallet today could shape the global economy for years to come. Mortgages are the biggest debt for most, and rising rates hit hard. In the US, fixed-rate mortgages offer stability, but new buyers face high costs. A low-rate mortgage is a golden ticket, making homeowners reluctant to sell. In Europe, shorter fixed-rate periods mean homeowners feel rate hikes directly. A rate increase can drastically raise monthly payments, straining budgets. The ECB's decisions have immediate, widespread effects on European homeowners. Rising rates can trigger housing market freezes and financial crises. It's a stark contrast in how rate changes impact homeowners across the Atlantic. Credit cards, once seen as magical keys to instant purchasing power, can quickly transform into financial monsters lurking in your wallet. At first, swiping that shiny piece of plastic feels empowering, letting you buy what you want, when you want. But beneath the surface, a hidden danger grows, especially when interest rates start to rise. What was once a tool for convenience can suddenly become a source of stress and anxiety as your monthly bill creeps higher and higher, almost as if it's growing fangs. The culprit, APRs or annual percentage rates, which are often variable and directly linked to central bank rates. When central banks hike their rates to combat inflation or stabilize the economy, credit card companies quickly follow suit, raising the interest rates on your outstanding balances. This means that the cost of carrying a balance on your card can skyrocket almost overnight, catching many consumers off guard. What seemed manageable last month can suddenly feel overwhelming, as the interest you owe multiplies with each billing cycle. In the United States, where consumer debt levels are historically high, these rate hikes hit especially hard. Millions of Americans rely on credit cards for everyday expenses, and when interest rates rise, so do their monthly payments. The result? Ballooning interest charges that can quickly spiral out of control, making it harder and harder to pay down the principal. For many, this means sacrificing other essentials just to keep up with mounting bills, leading to increased stress and financial insecurity. In Europe, the situation is a bit different. Fewer people carry large credit card balances compared to the US, but those who do are not immune to the pain of rising rates. For these consumers, even a small increase in interest can make a noticeable difference in their monthly budgets. The squeeze is real, and it's felt most acutely by those already struggling to make ends meet. As rates climb, more and more consumers find themselves trapped in a vicious cycle known as the debt spiral. Each month, a larger portion of their payment goes toward interest, rather than reducing the actual debt. This can lead to a sense of hopelessness, as the balance barely budges despite regular payments. The financial strain can spill over into other areas of life, affecting relationships, mental health, and overall well-being. The minimum payment trap is particularly dangerous. While it might seem like a lifeline, making only the minimum payment often means you're just covering the interest, with little left to chip away at the principal. Over time, this can add years to your repayment schedule and cost you hundreds or even thousands of dollars in extra interest. It's a cycle that's hard to break without a clear plan and disciplined budgeting. Whether you're in America or Europe, the impact of rising rates is immediate and widespread. Shoppers everywhere are feeling the pinch, rethinking their purchases and scrutinizing their statements more closely than ever before. The global nature of credit means that no one is truly insulated from these changes, and everyone must adapt to the new reality of higher borrowing costs. Ultimately, it's a sharp reminder that the convenience of credit comes at a cost. Each swipe is a decision, and in a world of rising rates, it pays to be more mindful than ever about how and when you use your card. By understanding the risks and planning ahead, you can avoid letting your credit card bill become a monster that haunts your financial future. Rising rates affect all major purchases, from cars to furniture. Car loans, once affordable, now come with higher interest, increasing monthly payments. This forces tough choices: cheaper cars, used options, or keeping old vehicles. In both the US and Europe, higher loan costs impact family budgets. Large purchases on credit become less appealing as financing costs rise. The shift from Buy now, pay later to wait and save is central bank's goal. It's a quiet decline in living standards, one loan at a time. Consumers must adapt to a new financial reality. Savings accounts are finally waking up with rising rates. For years, low rates punished savers, but now banks compete for deposits. Higher rates make saving attractive again, offering real returns. In the US, high-yield savings accounts provide a safe, low-risk option. In Europe, savers see better returns, though the pace varies by country. It's a return to rewarding thrift and financial prudence. Savers can now protect their purchasing power and earn meaningful interest. It's a small victory for the cautious in a risk-driven world. Rising rates change the investing landscape, ending the TINA era. Safer, interest-bearing assets become attractive, pulling money from stocks. Bond prices fall as rates rise, but new investors benefit from higher yields. In the US, rate hikes shock markets, shifting focus to stable, dividend-paying stocks. In Europe, diverse bond markets offer both risk and opportunity. The simple investing playbook of the past decade is obsolete. Investors must adapt to a new reality of higher rates and shifting opportunities. It's a challenging but potentially rewarding time for savvy investors. Rising rates create diverse outcomes for different people. In the US, fixed-rate mortgages protect some, while new buyers struggle. In Europe, adjustable rates mean homeowners face immediate financial strain. Investors like Linda in Florida and Klaus in Germany adapt to new realities. Linda finds stability in bonds, while Klaus welcomes positive returns. Rising rates reshape financial landscapes, impacting choices and luck. It's a tale of two economies with varied effects on individuals. Understanding these impacts is crucial for navigating the financial future. Interest rates are the economy's master control, affecting everyone. The US system shields some homeowners but punishes new buyers. In Europe, rate hikes impact millions directly, complicating ECB's task. Consumers must manage debt and protect savings in this new environment. The era of free money is over. Financial prudence is key. Central banks face a delicate balancing act to avoid recession or inflation. Stay informed and adapt to the changing financial landscape. The decisions of central banks will shape your financial world for years.